Professor Watson. Welcome to week number 10 of Managerial Finance. So this week is just a little bit of an extension of last week, right before spring break, so that would have been week 9. And we are going to continue working on bonds. So when we deal with these time value of money chapters, I always try to take 2 weeks because there's a lot to grasp. A lot more than a week will allow. Especially considering that this class is so self-taught on your part. So last week you guys really focused on the concepts of bonds, and this week we're going to actually focus on calculating bond value. Your book does a good job of breaking bonds down, breaking time value of money down. What your book doesn't do a good job of, I think, is breaking some of the most critical relationships with bonds down. And so I've created a little bit of a cheat sheet for you so that you can use that as you guys study for the test, as you work through your homework as well. So you have 18 problems, I believe, this week in your practice problem set in Cengage that you'll be working through. So let's talk about bonds. I'm going to go through the lecture that I would give in class to you today, and then the second part, I will also record some of the practice problems that you're going to go through so that you guys kind of have a better feel for how to solve for those for your homework this week. So what is a bond? So a bond is a debt instrument, and your book talks about how it is a debt instrument. And essentially, it's just another way for corporations or really anybody to get and use debt. So debt can be used by municipalities, by governments, by corporations, and that can be done in the form of bonds. A lot of people use bonds. So to give you a very, very general example of what a bond is, say that I am Apple, okay, and you are the investor. Let's say that I, as Apple, am going to issue bonds to the market, to you. So you would give me the general value of a bond is $1,000. So you would give me $1,000, and I, as Apple, would take that money, your $1,000, and let's say it's a 10-year bond. I'd hold that $1,000 for 10 years, and I would use it for whatever I need to do for Apple, whether it's creating a new iPhone, a new iWatch, whatever it is. And in return for that, I pay you what is called a coupon. And so that is your incentive as an investor to buy my bond for Apple. I pay you, let's say, $20 a year to borrow your $1,000, okay? So at the end of 10 years, I will give you your $1,000 back, okay? So during these 10 years, you as the investor earned $20 coupons every single year for 10 years, and then at the end of 10 years, I gave you your $1,000 back. And that's essentially a bond. We get a little bit more complex here, but go back to that example as you're thinking about bonds as we go through this lecture. So I'm going to go ahead and pull up your lecture here for you, and then I'm also going to pull up this little cheat sheet that I created for you, and we're just going to kind of go back and forth through the lecture and kind of talk about some of these relationships. So in your Chapter 7 lecture, which I've also uploaded to week 10 for you, and I have uploaded this cheat sheet to week 10 for you as well. So we're going to talk about some of the key features of bonds. We're going to talk about bond valuation and actually valuing bonds. We're going to talk about risk, measuring yield, and also assessing risk of a company as well. So your book defines a bond as a long-term debt instrument in which a borrower agrees to make payments of principal and interest on specific dates to the holders of the bond. So remember the Apple and you example that I just gave you. I was making you payments as Apple, which is that coupon, which is technically interest on specific dates, so every year for 10 years to the holder of the bond, and that's you. You are the investor in that situation. So let's stop right here and let's go to the right-hand side of the screen here, and I have this Word document up, and you'll notice that in that document I have broken out calculator inputs, time value of money, and bonds. So bonds are very, very simple. You're going to take the time value of money concepts that you learned. Remember a few weeks ago I told you that it's really critical to get these time value of money concepts down because they're going to carry into the rest of the semester. Well, it's very, very true here because with bonds, we're using all the same rules. We're just applying different vocab, and the vocab gets people tripped up. And so that's why I created this little cheat sheet here for you. So you'll notice on the left-hand side of this table here, I've put in your calculator input. So remember on your financial calculator, remember right here from left to right, you have all of these inputs, your N, IY, PV, PMT, and FV, right? So those are your calculator inputs. And in time value of money, we knew our N as the period. We knew our IY as our interest rate. We knew our PV, which was our present value. We knew that our PMT was our payment, and that our future value was, well, our FV was our future value. Well, in bonds, it changes just a little bit, okay? So use this cheat sheet as you go through these chapters to kind of help you understand the vocabulary. So coming back to your lecture here on the left-hand side, your bonds are traded on over-the-counter markets. You learned about over-the-counter markets in the first couple chapters of this class. So they're the electronic markets. And most bonds are traded among the largest financial institutions in the world. So, our big corporate companies that we talk about, Tesla, Apple, all these people, they don't just go to the bank for money to get debt from the bank for, a bank loan. They also issue bonds to do that as well. And later in the semester, we'll talk about how they do that with stocks. So some of the vocabulary with bonds, we have broken down the characteristics of a bond here for you. So the first one you see is called par value. So in your example that I gave you in the beginning of this lecture, I said, remember, I as Apple asked you for $1,000. So you gave me $1,000. Well, that's called par value. That's the face amount of the bond. That's also the amount that's paid at maturity. So for this entire class, we always assume, unless otherwise told, that our par value is $1,000. So what in the heck is par value? Par value, if you come back over here to the right-hand side of the screen to your cheat sheet, you'll notice that par value is actually your future value. So as we go through here, we're going to start evaluating the value of bonds, and you're going to notice your present value is not always $1,000. Your present value could be $880. Your present value could be $1,100. But your future value is your par value, and it will always be $1,000 unless otherwise. Then we have this another term called the coupon interest rate, and that's your stated interest rate, and it's generally fixed and paid by the issuer. And so remember that coupon payment I was telling you about earlier? That is derived from your coupon interest rate, and that's found by taking the par value, so that $1,000 we were just talking about, and multiplying it by your coupon interest rate, and that gives you your coupon. So our future value over here on the right-hand side of our calculator is our par value, and our payment, on the other hand, what we used to know as the payment in our calculator, is actually now known as a coupon with bonds, okay? And we'll talk a little bit later about how to calculate that. A maturity date. So with a bond, your bond has a maturity date. And remember in the first example, I gave you 10 years. Well, that was the maturity date on that bond. It's how many years until the bond must be repaid. So I have 10 years as Apple to repay the bond that we issued to you. So the N in your calculator, you probably knew it as period and time value of money. Well, with bonds, it's now called the maturity date. There's an issue date, so that's when your bond was issued. We don't use this a ton unless we are going through story problems and we're getting a little bit more complex. We might throw an issue date at you, but a majority of the time you're going to use maturity date. And then yield to maturity. So yield to maturity is the rate of return earned on the bond and held until maturity. So this is the promised yield. This is how much you will earn on this bond if held to maturity. So that IY in our calculator, we've been talking about interest rate. That's actually called yield to maturity. Your book will also call yield to maturity R, so I put that in there as well for you to kind of get familiar with that. And then the very last, I know we are completely out of order here, but the very last input in your calculator is that PV, and that's just the price. That's the price of the bond today, the present value of the bond, or what we otherwise know as price. So let's get into some of the features of a bond. So there's a few different features of a bond. One of them is called a call provision. So a call provision allows the issuer to refund the bond issue if rates decline. So it helps the issuer, but it hurts the investor. So this is kind of where your book doesn't quite explain the relationship. So in your cheat sheet over here, if you go down to the bottom of the cheat sheet, I've done this relationship between bonds and interest rate example for you. So you'll notice that the bond value, or the price of the bond has an inverse relationship with the market bond rate. So if my bond, let's say if my market rate goes down, my bond value goes up. So why is that? How does that even make any sense? So another key piece to remember with these bonds is that your bond, when issued, is fixed. Its rate is fixed. So that bond that I issued you over 10 years, its rate will never change, okay? So I'll give you an example. Let's say today that your bond was issued at 10%, okay? And when you issue a bond, it is always at the same rate that the market is currently at that day. So the market rate will equal your bond rate. So if I issue you one today and the market's at 10%, your bond is at 10%, okay? So they're equal. It's worth $1,000. It's flush. Now let's say that the bond market 2 years from now goes down to 8%. So your bond is earning 10% in the market, while the market rate is 8%. So your bond is worth more. So if my market rates go down to 8%, my bond value goes up because my bond is earning more than the market is. Now vice versa, let's take that same 10% bond and let's say that the bond market rate goes up to 12%. So the market rate has gone up to 12%, but my bond is only earning 10%, so my bond price decreases because my bond is not earning as much as the market is, therefore it drops its price. It's not as highly demanded. So think about that relationship. Pause if you need to, but think about it and let's go back to the call provision. So it says it allows the issuer to refund the bond issue if rates decline. So if I am Apple, and I've issued bonds at 10% and the market's now dropped to 8%, I am paying my bondholders way more than I could just be paying at market rate at that 8%. So it's very advantageous for me as the issuer of those bonds to put in a call provision. And basically I pay my investors back, I pay them back, and I go back to the market and buy cheaper bonds at 8% instead of paying them 10%. So it helps the issuer, it helps me as Apple, but it hurts you as an investor, okay? So the bond investors require a higher yield on callable bonds. So they require a higher rate of return on these bonds, you as the investor would, because there's a higher risk that I as Apple could come back and call that bond if rates are not advantageous to me. Okay, so if rates drop in the market and I have to pay you more than the market, you're going to require a higher yield on that because there's a higher risk to you. So in many cases, callable bonds include a deferred call provision. And a deferred call provision basically says that I as Apple have to wait a certain time until I can call that bond. So it's 3 years to call that bond. So I have some kind of protection as an investor there. So a sinking fund, most of the bonds here, we are just going to assume they're fixed rate, the par value is always $1,000, and we don't have a sinking fund involved. So that means that I'm just paying a coupon rate, right? As the issuer, I'm just paying you a coupon rate as an investor. A sinking fund, on the other hand, it's a provision to pay off the loan over its life rather than at maturity. So instead of me paying you a coupon and then paying you the full par value at the end of the life of the bond, I pay you both principal and interest, just like an amortization schedule on a loan. So just like we talked about in the last module, this looks just like an amortization schedule. So I'm paying you both principal and interest on the bond. Fortunately, we don't deal with those a lot in our questions and practice problems, but just remember a sinking fund is like an amortization schedule on a loan. And then your book goes into how sinking funds are executed. I'll let you read a little bit more on that as I want to get into some of the other types of bonds and how to calculate them. So I'll also let you go through your book to read about all the different types of bonds, but a couple that we highlight here. We have a convertible bond, so that may be exchanged for common stock of the firm at the holder's option. So you may find that you might earn more putting your money into stock in a company than bonds, therefore you can convert your bond into stock at some point. A warrant, that's a long-term option to buy a stated number of shares of common stock at a specified price, so that's more of a locked-in contracted price, but you can still convert your bond to stock at some point. So we were just talking about a call provision. We have something that's called a puttable bond, and that allows the holder to sell the bond back to the company prior to maturity. So instead of me as Apple having a call provision that puts all the power in my hands, a puttable bond puts all the power in your hands as an investor, and it allows you to sell the bond back to the company prior to maturity. So let's say that market rates went up and your bond was earning 10%, but the market was really earning 15%, you could have a puttable bond and give it back to me because you want to go to the market and earn 15% instead of earning 10%, perhaps. So an interest only when interest is earned by the firm. So you only get paid interest on that bond if the company is making money, essentially. And then an index bond helps you mitigate the risk of inflation. So remember, bonds are long-term debt instruments, and inflation is very, very likely during that time. And so an index bond helps protect you from inflation so that you don't lose money to that index or to the inflation index. So your book talks about opportunity cost of capital, debt capital, excuse me. I will let you go ahead and read on that. It also breaks out the timeline here for you as well. But in this, it asks you, what's the value of a 10-year, 10% annual coupon bond if the rate or the yield to maturity is 10%? So let's break this question down. And I'm going to help you. I'm going to flip to the next slide here, slide 12. And we're just going to go ahead and plug this into our calculator just like we have been. So I'm going to pull my calculator up here. And at this point, guys, you should be very, very comfortable with your calculator. I'm not going to plug all of these in here for you. If you're struggling, please reach out to me. I'm always happy to answer those questions for you or do a little one-on-one session. But so it says, what is the value? Let's go back to slide 11. What's the value of a 10-year bond that has a 10% annual coupon bond if the rate or yield to maturity is 10%? Okay. So if I was going to break that question down here, I'm going to move my calculator over just a bit so you can see this cheat sheet, okay? So I know that the maturity, remember the maturity is the N in my calculator. I know that the maturity is 10. So I can just go ahead and plug in 10 here into my calculator, okay? And the interest rate, or the R, you'll notice that in this question, instead of saying yield to maturity, they told you that it was R, okay? So that's kind of where the vocab really starts to change here. So that's really our IY, right? It's our rate, it's our yield to maturity. So they told you that that's 10%. So you can plug that in for your IY. And then they told you you have a 10% coupon payment, okay? 10% coupon payment. Well, you can't just plug 10% in here for the payment and expect it to calculate. The calculator needs to know what the exact figure of that payment is. So remember to calculate your coupons, and maybe it would just be helpful here. Over here in your cheat sheet, I'll re-upload this for you. So your coupons is your coupon rate multiplied by par value, okay? So I'll X this out for you. So it's your coupon rate multiplied by par value. So remember that my par value in all these questions is always $1,000. So that's a given. We can plug in, I'll just do this here for you. We can plug in $1,000 into this question. And then we're going to multiply that by our coupon rate. So remember they said, hey, your coupon rate is 10%. So 10% times 1,000 is $100. So in my calculator here, I'm going to plug in $100. And remember, my future value or my par value is always $1,000, okay? Unless otherwise stated. So I'm trying to find the present value of my bond. So if I click compute present value, I find out that my bond value today is $1,000, okay? This is what we call par value. So on your cheat sheet over here, right in the middle, I'll go ahead and move this down. On your cheat sheet over here in the middle, I broke out the relationship for premium par and discounted bonds. So you'll notice here, right in the middle, it says par value. If my bond is at par value, that means that my yield to maturity is equal to my coupon rate, okay? So this is a pretty important concept here. If I am at par value, my yield to maturity, or my IY, is equal to my coupon rate or my payment. Remember, So if we go back to slide 11 here, they said my 10% annual coupon bond and my 10% rate or yield to maturity. So if that holds true, that relationship is true here, then I would be at par value, or my bond today is worth $1,000. And there's proof right there. You can see that right there. And it's no surprise. All of our factors are very even and constant here. It's no surprise that that came out as 1,000, but that's what we call par value. And this is a really, really important relationship that you need to understand, but it's really important as you go through these problems, because you can use this relationship to help fact check you as you work through these problems. So before you'd ever solved for this, even if you didn't know this was going to come out to $1,000, before you'd ever solve for this, if you knew that your yield to maturity was 10% and your coupon rate was 10%, you would have known that this bond would have been worth $1,000 before you ever plugged it in, okay? So let's try another one. Let's see if this rule that I just told you holds true. So in slide 13 here, it says, what's the value of a 10-year bond outstanding with the same risk but a 13% annual coupon rate? So in this scenario, your maturity is still the same, your N is still 10, your rate on the market, or your yield to maturity, is still 10%, but what's changed here is that your coupon rate is now 13%. So remember, we take that nice little equation that I gave you here, and we're going to plug in 13% times 1,000, and that's where we get that coupon of $130, okay? So before we even solve for this, before we even plug it into our calculator, we could look at this rule and say, okay, my yield to maturity is less than my coupon rate, therefore my bond is going to be worth more than $1,000, or what we call premium, okay? So if I'm at par value, my bond's at 1,000. If I'm at premium, my bond is worth more than 1,000. And if I'm discounted, my bond is worth less than 1,000, okay? So does this rule hold true? If my yield to maturity is 10%, if my coupon rate is 13%, this would say that my bond would be at a premium. So if you plug this into your calculator, and I'll do this one for you. If you plug this guy into your calculator, we'll clear it out here. So we'll put in 10 for our N, 10 for our yield to maturity. We're going to skip over present value because that's what we're solving for. We're going to plug in 130 for our coupons and $1,000 for our par value. If we compute that for our present value, or the price of our bond, we'll notice that our bond today is worth $1,184.34, okay? So that puts my bond at a premium, okay? So what this says, this is a hard concept for people to grasp with bonds. If we go back to slide 12 quickly, if we go back here, this is what a bond looks like when it's issued, the day that it's issued, okay? So my market, my IY right here, is at 10%, therefore my bond was also issued at 10%, therefore I paid $1,000, right? My bond was worth $1,000 today because everything was equal, because it was par value. Now remember what I told you earlier, your bond is fixed. Your bond's rate doesn't go anywhere, okay? So what this scenario assumes is that my bond was issued at 13%, but something happened in the market that dropped the bond market rate to 10%. So my bond, because it's a fixed rate locked in bond, is earning 13% while the market is earning 10%. And so my bond is worth more than the rest of the bonds on the market being issued today, okay? Therefore, you would have to pay a premium, or a price higher than par value, to buy my bond. Now, another thing to keep in mind with bonds, unless you have a call or a put on a bond can't just go away because you don't want to hold it anymore, right? Let's say you're 5 years into your bond and you want to sell it. You don't just sell it back to the company, you sell it back to another bondholder on the secondary market, right? So if that were the case, if somebody came to me today in this scenario and said, hey, I want to buy that bond from you, I would say, you're going to have to pay a premium. You're going to have to pay me $1,100 because my bond is worth more on the market. And that's what that PV, or that price, is telling us there. That's the true intrinsic value of that bond, okay? So let's flip it. Let's see if the rule holds true the other way. So it says it's the same 10-year bond. The market is still at a 10% rate, and my payment or my coupon rate is actually now at 7%. So before I even solve for this thing, let's go ahead and look at our rules. So the very last rule we haven't used is discount. So it's saying my yield to maturity right here is greater than my coupon rate. So my yield to maturity is 10%, but my coupon rate that I'm earning is 7%, okay? So if that's greater than my coupon rate, I'm at a discount. So this is where you fact check yourself on these questions. If you plug this into your calculator and you came up with a present value higher than $1,000, you know you got an input here wrong somewhere, because we know that this rule holds true, that my yield to maturity is greater than my coupon rate, therefore my price will be less than $1,000. So if I plug this into my calculator, and I'll let you plug this one in, my present value comes out at $815. So what's the real world scenario here? So what this is saying is that the market's earning 10%. My bond is only earning 7%. Therefore, if I want to get out of this bond, I have to sell my bond to another bondholder at a discounted rate, right? That's the incentive for them to get involved here. I'll sell it to you for less than $1,000. You can buy it for $815 today. You're going to get $1,000 back in the future, okay? So it's at a discount because it's not worth as much. So in a nutshell, that's a very simple breakdown of premium, par, and discount, but it's a really, really critical relationship for you to learn because it helps you fact check yourself as you work through these problems. So I challenge you guys, before you really get into the homework, make sure you really understand these two principles. Premium, par, and discount, understand what drives those factors. It's a relationship between yield to maturity and your coupon rate. And then also make sure that you guys really understand the difference between a bond price and the market bond rate, okay? So interest rates and price of my bond. Make sure that you understand their inverted or their inverse relationship and why they're inverse. So changes in bond value over time. I like this graph because really it just shows you, regardless of what you buy, so over here, regardless of what you buy your bond at today. So remember, one of our bonds was worth $1,100, one of them was worth roughly $800. Regardless of what you buy your bond at today, whether it's premium, par, or discounted, at the end of the maturity of this bond, you're still going to get $1,000 back, period. That's par value, period. So it doesn't matter what you pay for it today, it will always come back to par value over time, okay? So if you pay $1,100 today and you only get $1,000 back in the future, you better make sure that that investment's worth it, right? And vice versa, if you pay $816 today and you're going to get $1,000 back in the future, is that investment worth it to you? But it just goes to show that everything comes back to equilibrium in the market and then everything comes back to par value. And then this just kind of describes exactly what we just said there. So with bond valuation, just like with time value of money, you aren't just going to solve for your present value in your calculator or the price of your bond. You can also solve for other factors. And so here in this question, we're going to solve for yield to maturity, okay? So let's look at this question. It says this is a 10-year, 9% annual coupon bond. It's $1,000 par value, and today it's selling for $887, okay? So before you guys even solve for this question, we can go back and use our rules right here, our premium, par, and discounted bond rule, to see if our answer is correct, or at least, fact check ourselves here. So let's take a look at our annual coupon rate and our selling price, because that's all we have here, right? So the coupon rate is 9%. But we know that looking at the selling price, because it is below $1,000, it's going to be discounted. So if you go back to your rule here, if you go back to your discount bond rule, to be discounted, your yield to maturity has to be greater than your coupon rate. And so my coupon rate is 9% today, okay? So I know that when I solve for this, my yield to maturity when I solve for it will have to be greater than 9%, okay? So that's how I check my work. So let's go over here to our calculator, clear it out, and let's just go ahead and plug this guy into our calculator. So it's a 10-year maturity, so we're going to plug that in for N. We are solving for our yield to maturity, so remember from your cheat sheet back here that your yield to maturity is your IY, so we're just going to skip over that. They told us that today our bond is selling for $887, so remember that's going to be negative. Remember where your cash flows are going, $87 for that bond today, so that cash flow is going to leave my pocket. My payment or my coupon in this question is going to be $90. And remember, I get that from multiplying my coupon rate and multiplying that by my par value. So that's going to give me 90. So I'm going to go ahead and plug that in for my coupon or my payment in your calculator. And then remember, unless you're otherwise told, your par value or your future value is always 1,000, okay? So if we go ahead and compute for our yield to maturity, you'll notice that our yield to maturity comes out to 10.91. So did our rule hold true? My coupon rate was 9%, and my yield to maturity is 10.91. Therefore, I know that I'm probably pretty close. I'm within the ballpark of that answer as I work through this, okay? So are we right? Let's go to slide 18. Yes, we are. There's the workout for you if you want to plug it into your calculator. So again, this is a great relationship and tool to use as you work through this. So find the yield to maturity if the bond price is $1,134.20. So this is the same question. All we did is we changed the present value of our bond and solved for that yield to maturity. So before we had solved for this, we could go back and look at our rule here on our cheat sheet and say, okay, my bond, if it's selling today at $1,100 roughly, that's a premium bond because that's over $1,000. So my premium bond rule says that my yield to maturity is less than my coupon rate. So if I went back here, I know my coupon rate is 9%, therefore you would know that your yield to maturity had to be less than 9%. And sure enough, when we solve for it, your yield to maturity is 7%, okay? So on your homework, we don't just ask you to plug different inputs and factors into your calculator. We also have a different way to solve for yield to maturity, okay? So unlike the example we just did, we can actually do some pencil and paper math and solve for it. So expected return or yield to maturity is actually your expected capital gains plus your expected current yield plus your expected capital gains. So in this slide, they break that out for you. They say your current yield is your annual coupon payment divided by your current price, and your capital gains yield is the change in price divided by the beginning price. So essentially, this is kind of that plug and play algebra. You could solve for any one of these factors in here as long as you had the other two factors, okay? And these are homework problems. And so we can work through some of these. Your lecture gives you a really very simple example. Your homework gets a little bit more complex, and in the next video we can work through some of that. But it says, for example, find the current yield and the capital gains yield for a 10-year 9% annual coupon bond that sells for $887 and has a face value of $1,000. So you might notice that this is the exact question we solved for earlier. And let's see. Yep, we solved for this one in slide 18 right here, okay? So we're going to use this. So if we come back to slide 21 here, we're going to use that current yield calculation. So we're going to take our $90, which is our coupon, and divide it by our price, and we're going to get 10.15, and that is the current yield on the bond, okay? So that's one part of the three. So remember, here's our calculation for yield to maturity, and you have two of those factors, so you can solve for the missing factors. So what we did here is we just rearranged our calculation. We took our yield to maturity to the right side and brought our capital gains yield to the other side. So we could plug in the yield to maturity that we solved for in slide 18 and deduct or subtract our current yield, and that would tell us what our capital gains yield was. So we gained 7.76% on this bond. So not all questions are worded like that. Sometimes you're solving for your current yield. Maybe you're solving for yield to maturity. It just kind of depends, but those questions are actually very simple. It just takes a little practice on which factors you have and how to plug them in. So there's a couple different risks that we talk about in this chapter. One of them is called price risk, and another one is called reinvestment risk. So let's break down price risk really quick. So price risk is a concern that the rising rate, market rate, yield to maturity, will cause the value of the bond to fall, okay? So it's asking, does a 1-year bond or a 10-year bond have more price risk? So if we think about that, if this has to do with our interest rate on the market, a 10-year bond is going to be more sensitive to interest rate changes, hence it has more price risk, okay? So basically when you think about price risk, think short term, there is a less likelihood that my interest rate is going to change within a year, but there is a significant likelihood that my interest rate will change dramatically in 10 years, right? So you'll notice they've broken it down here for you. And they say, if this is my rate, 10%, 5%, 15%, and this is the change. And so, and same for the 10-year. And so this is a great calculation of that, but just think with price risk, if I'm dealing with my interest rate, in the long term, my interest rate is going to fluctuate more than in the short term. And if you're a visual learner, here's the illustration of price risk for you as well. So you'll notice that that 10-year bond has far more volatility when it comes to interest rate than the 1-year bond does. Now let's think about reinvestment risk. So reinvestment risk is the concern that your rate will fall and future cash flows will have to be reinvested at lower rates, therefore reducing your income, okay? So suppose you just won $500,000 playing the lottery. You intend to invest the money and live off the interest, okay? So $500,000, you intend to invest the money and live off interest. So let's give you a couple scenarios here. So with reinvestment risk, you could take your $500,000 and you could invest it either into a 10-year bond or a series of 10 1-year bonds. So both of the bond proposals have the same exact current yield, okay? So same rate. So you can bet that the relationship's probably inverse from your price risk. And if you thought that, you're right. So if you choose a 1-year bond strategy, after year 1, you receive $50,000 in income and you have $500,000 to reinvest. But if your 1-year rates fall to 3%, your annual income falls to 15%. So when it comes to reinvestment risk, short term is more dangerous than long term, because had you have chosen the 10-year strategy, you could have locked in that 10% interest rate and would have had $50,000 annual income for 10 years, assuming that that bond can't be called, but we'll assume that it can, okay? So with reinvestment risk, you have a higher likelihood of the price changing or falling in this case, and you would have to pull out of that investment and you'd have far less money had you locked it in long term with a 10-year bond. So after all of that, the conclusion here is this nice little graph about price risk and reinvestment risk. So price risk, short-term bonds are low, but long-term bonds are high. And when it comes to reinvestment risk, short-term bonds have a high risk and long-term bonds have a low risk. And your book comes to the conclusion that nothing is riskless, and that is very, very true. Okay, let's calculate a couple more bonds here. And then we're going to talk about some of the risks of bonds with a company, and we're going to talk about bankruptcy risks. But let's talk about semi-annual bonds. So it looks a lot like your time value of money concepts. Remember the timeline, how we had a 10-year timeline, but because we were semi-annual, instead of having 10 periods, we had 20 periods. Well, this is the same thing, but we have a nice little set of rules that we follow when we solve these semi-annual bonds. So the rules are, remember you can draw out your timeline, and if anything is anything other than annual or semi-annual, we double the amount of periods, okay? So it would make sense that we would multiply our periods by how many times we're multiplying. So if I have a 10-year bond and it's semi-annual, instead of 10 periods, I have 20, right? Now remember, if anything is more than annual, compounds more than annual, we have to divide our rate by whatever that period is. So we would divide our yield to maturity by 2, and we would divide our payment by 2, right? Because it's semi-annual, there's 2 periods within the year. So let's go ahead and apply these rules real quick. So it says, what's the value of a 10-year, 10% semi-annual coupon bond if the rate or yield to maturity is 13%? So if I follow my rules, my N or my maturity is 10, but because this is semi-annual, I multiply it by 2 and I get 20, okay? Then I have to divide my rate. So it said that your rate, or your yield to maturity, was 13%. But if we divide that, it becomes 6.5, okay? And then your coupon, you can solve this one of two ways. You can immediately divide the coupon rate if you want to, or you can solve for the full annual coupon and then just divide the coupon payment. However you want to do it. But what it's saying here is that my coupon rate was 10%, so my annual coupon would essentially be $100, and if I divide that by 2, it becomes 50. You could have divided the rate there if you wanted to, however you want to solve that. And your future value in this question is $1,000, okay? So it says my present value today is $834.72. You could have gone back to your rule here and fact check yourself. Your yield to maturity was greater than your coupon rate. So your yield to maturity was 6.5 and your coupon rate was 5%. Therefore, your bond would have been trading at a discount. And if you solve that, that would have been true because $834 is less than $1,000, right? And that's as simple as that with your semi-annual. You just have to remember that you multiply your period by 2 and you divide all your rates by 2, okay? So, with time value of money, we solved that problem by using the effective annual rate, or EAR. And you could have done the same thing here with bonds. It depends how you want to solve it. If it's easier for you to use the 3-step rule, if it's easier for you to solve your effective annual rate, whatever it is, you could have just plugged it into the calculation, that semi-annual bond rule, could have plugged it in here, and instead of getting a rate of 10%, you would have got a rate of 10.25%, okay? So you could come over here and you could go ahead and plug that in as well, holding everything else constant, just like you normally would, and could have solved for a present value as well. So there's a couple different ways to solve for that. And then they give you an example here on page 32 about how to calculate a yield to call. So what we have been doing this whole time is yield to maturity, and what that assumes is that that bond is held until the maturity. So whatever my N was, that's my maturity. I'm holding it to that time period, therefore I'm solving for my yield to maturity. But what this problem assumes is that you are solving for yield to call. And so it says you have a 10-year bond. It has a 10% semi-annual coupon bond selling for $1,135 and can be called in 4 years for $1,050. What is its yield to call? So anytime you see yield to call, notice that you're going to have to dig a little bit deeper into this question, okay? Because what's happening here is they're not holding the bond for 10 years. The issuer is calling the bond back, or they're paying you as an investor back at a certain time period earlier than the maturity of that bond. To make this question even more complex, they add a semi-annual coupon bond, right? That's the fun of learning. We just keep layering. So in this question, my N is 8. My maturity is 8. Well, where did I get that from? So you'll notice it's a 10-year bond, but it said it can be called in 4 years. And so the call happened at year 4 in our bond. But because this is semi-annual, remember we're going to multiply our N by 2, and that's where we get 8, okay? What we're trying to find here is that rate, so we're just going to skip over that. They told you that your present value, or the price of your bond today, is selling for $1,135.90, so you're going to plug that in for your present value. Remember, that's negative. That's how much you'd have to pay for it. And then the payment, they told you that this bond had a 10% semi-annual coupon, so that the coupon on this, following your calculations here, would have been $100, but because we are dealing semi-annually, we're going to divide that coupon rate, therefore our coupon becomes 50. And the future value on this bond, remember, I told you unless otherwise stated, your par value is always $1,000. But in this situation, your par value is $1,050. And so the future value changes in this question and does not hold at $1,000, okay? So if we calculate that, we get a yield to call of 3.56%. Now remember, like with time value of money, that 3.56%, that isn't your annual rate, that's your semi-annual rate. So you need to take that rate and you need to multiply it by your period, and because we're dealing with semi-annual here, my yield to call is actually 7.13%, okay? So essentially what you're taking away from this yield to call problem is that if your bond is called, you're not going to earn as much as if you earned yield to maturity, okay? So if the bond is being called, you will never earn as much as if you held it to yield to maturity. And I like how your lecture really breaks this down here. They say the coupon rate is 10% compared to your yield to call of 7.13%. So had you just held the bond to, the full maturity, you would have been earning $100 per year. But because this bond got called early, you're really only earning $71.37 per year. So remember, if your bond's being called, you're never going to earn as much as if you held it to maturity. Okay, so let's talk about default risk. So getting away from the calculations, part of your test is going to talk about default risk, okay? So a default risk essentially is if a company goes upside down, if they go bankrupt, if they really screw up and they lose all their money for some reason. Your book defines it as if an issuer defaults, investors receive less than the promised return. Therefore, the expected return on corporate and municipal bonds is less than the promised return. All that says is the company promised you a certain return and you're not going to get it. So you're going to lose money. You're going to make less than you thought you were. So default risk is important because it's influenced by all sorts of things. It's influenced by the issuer's financial strength. It's influenced by the economy. It's influenced by the industry. It's influenced by the terms of the bond contract. So that's kind of what we're going to break down here and briefly talk about. Your book breaks it out more than I probably will, but just on a high level, we'll kind of talk about some of that risk. So we have all different types of bonds. We have mortgage bonds. So, well, let me explain the rating before I get into mortgage bonds. But mortgage bonds essentially are a bond that are comprised of mortgages. So your home mortgage could be packaged into an investment tool like a bond and purchased by an investor. Debentures are unsecured bonds. So they're not secured by anything. So if the company goes bankrupt, that bond isn't secured by anything, so nothing of collateral value can be sold to help pay that bond back. So debentures aren't the best kind of bond. They're not backed like a mortgage bond is with a home. They're backed by nothing. So to make it even worse, we have subordinated debentures, and anything that's subordinated means it comes second in line to something else. So a subordinated debenture is still an unsecured bond, but it's paid behind a debenture. We have investment grade bonds, which are the very best type of bond that you can have. And then we have junk bonds. And those are the bonds that you don't want to get involved with unless you're a very savvy investor. But most of the time, they're probably not going to return you anything, okay? So we have two different rating agencies. We have Moody's and we have Standard & Poor's or S&P. You've probably heard of them. And the bond rating agencies were created to do all of the research, the financial research, everything that you need to know about the bonds. As an investor, you can just use the rating and invest. Somebody, a researcher, an analyst, a financial analyst on the back end has done all the hard work for you and put together this nice rating scale. And the bond ratings are designed to reflect the probability of a bond issue going into default. So they're designed to predict the likelihood of a company going into bankruptcy is essentially what that's saying. If you studied the mortgage crisis or the housing crisis, many people, you might have heard, many people blame the bond rating agencies for the downfall of the housing market. What happened in the housing market is people and investors got involved in these nice mortgage bonds, but what happened was the mortgage rating companies lied about the bond quality, about the rating of these mortgage bonds. And when they were really a junk bond, because the mortgages were all bad, these people couldn't actually pay these mortgages back. Instead of saying this mortgage bond is full of really bad mortgages that are going to default and go bankrupt, instead of giving it a C rating, they gave it a AAA rating. And so a lot of people blame the bond agencies for falsely rating mortgage bonds and lying to and deceiving investors in the market. So not to get on a total tangent, but that's a big thing with bond ratings. a big problem with the mortgage industry, and they came under a lot of fire and had to pay a lot of money for that because they were a big key player in the housing crisis. Other factors that affect default rate. So that bond rating is comprised of all of this, these financial analysts going through and looking at all these different factors. So we remember back in chapter 4, I think we did ratio analysis. So they look at the financial performance of the company. They look at the debt ratio. They say, how many assets do you have for every dollar of debt? Are you upside down? Do you have enough to cover it? What's your times interest earned ratio? Can you pay the bank back the interest payment to borrow their money? What's your current ratio? For every dollar of liabilities, how many dollars of assets do you have? And hopefully it's more than one. There's also qualitative factors. So bond contract terms. Is the bond secured or is the bond unsecured? If you're an unsecured debt compared to secured debt, you might be a little bit concerned. Is the debt, if you're subordinated debt, you're behind senior debt, that's something to consider. Is there a guarantee or is there a sinking fund provision? How long is the debt going to go on? Is it a 10-year bond? Is it a 20-year bond? Is it a 30-year bond? And what can happen in those 30 years? So there's a lot of qualitative factors that they also take into consideration here. Other miscellaneous but qualitative factors that they look at with those bond ratings is earnings stability. How likely is it that your company is going to keep, earning money based on whatever you're selling, based on whatever you're doing? What's the regulatory environment of your company? Are you, in oil and gas where you're heavily regulated? Are you an environmental company? Are there regulatory regulations that could come down and crush your company, in the future? There's product liability. There's antitrust. Are you Samsung with a faulty product that's starting on fire? That could significantly impact the cash flow of your company. Is there pension liability? Is there labor problems within your industry? Do you have enough workforce to power your industry, to keep your company going? So it's not just financial ratios that we look at. It's not just bond contracts that we look at. We look at the economy as a whole. We look at micro, macro factors. We look at internal, external factors within the company. And these are all the things that go into that bond rating. So it's a very well analyzed, very well researched rating that we use, and for a good reason. It makes your life as an investor much easier. So with all that to say, what happens is if there is default risk in a company and things really go sideways, upside down, and a company goes bankrupt, there's two types of bankruptcies that a corporation can file. The first one is Chapter 11, that's reorganization. That essentially says that we're not going to shut the company down, we're not going to liquidate, we're not going to go out of business, we're just going to reorganize so that we can function financially properly, so that we can keep our heads above water without drowning. Chapter 7 is the worst of the worst, that's liquidation. That means that there is absolutely nothing left, that we're going to liquidate everything, that your company won't be around anymore. That's it. So for larger organizations, most of the time, reorganization occurs because we like to use the saying that you're better alive than dead. So liquidation isn't good because businesses have a lot of shareholders. They have a lot of stockholders. They have a lot of people that they affect. And it's better if that business stays alive than if they die, because they can affect more people if they choose a liquidation or a Chapter 7. So Chapter 11 bankruptcy, if a company can't meet its obligations, it files a Chapter 11, and what this allows them to do is it allows all creditors, so all people that you owe money to that are banging on your front door, it allows them to completely cease and desist that, come after you, anything like that. It stops that. It stops anyone from taking your assets. It stops from the business closing, and it gives you 120 days from that point in time to file a reorganization plan. So you sit down with your team and you file a plan to help your company stay afloat. Okay, so you have 120 days to do that. So then the court appoints a trustee to supervise the reorganization. So they will help you work through the reorganization of your company, and that's somebody from the bankruptcy court that will work with you. And then generally in these situations, it's not like a hostile takeover. Generally in a Chapter 11, your core management team stays in place. They likely will have to do layoffs. They might have to liquidate assets. They might have to pay off debt, whatever it is, but the management usually stays in control. The company must demonstrate in 120 days that it is better reorganized and it is worth more alive than dead. If it can't do that within 120 days, the bankruptcy court will order liquidation and file a Chapter 7 on the company. So, Chapter 7, we're going to liquidate everything. We're going to try to get money out of everything, and we're going to shut down. This is a nice, priority of claims chart that shows you who gets paid first in a Series 7 or Chapter 7. So the first people that get paid is anybody who's a secured creditor, and a secured creditor is oftentimes the big banks. So think about the person that financed your big warehouse as a company, anybody who has equipment, anything that can be sold for liquidation for money, they're paid first, right? Because they secured that collateral. The next people paid is the bankruptcy court. So that's number 2, that's the trustee costs. So you pay the secured creditors, then you pay the court, and then your employees become number 3. So if you have any money left after that, your employees' wages will get paid. And then number 4 is taxes. So then the government will get paid. So you'd think that you'd pay your employees first, but really when it comes down to bankruptcy, the big banks and the bankruptcy court are the first 2 people in line. Seems unfair, but it's true. And to be honest, in a lot of bankruptcy situations, we don't ever see the trickle-down effect, the waterfall effect of that cash go past taxes to the government. If it does happen to go past that, they will fund any unfunded pensions, so pensions for their employees, any liabilities there. They will then fund unsecured creditors, so bondholders. This is where bondholders come in. We always talk about that bonds are a way safer investment than stocks, but they really are not that much more safe if you actually look at the priority of claims here of liquidation. Bonds are just one step above stock, okay? So we always preach how safe they are as an investment, but they truly, if you look at it, are not. And if for some reason your liquidation waterfall trickles all the way down to your stockholders, there probably was no reason for you to liquidate your company because you had enough money to satisfy your obligations. And so those stocks, we always call them risky investments. Well, it's because in the event of a liquidation, they are the very last people to get paid. So reorganization, in a liquidation, unsecured creditors receive nothing, so that's you as a bondholder, you generally receive nothing in a liquidation. And this makes those bondholders much more willing to participate in a reorganization, even if their claims are greatly scaled back. Even if you get some money back, the bondholders and the stockholders on the back of that liquidation stack, they are going to do anything they can to reorganize the company because they're going to try to redeem any amount of their investment. So various groups of creditors vote on the reorganization plan, and if both the majority of the creditors and the judges approve, the company emerges from bankruptcy. And the nice part about a reorganization is that you lower your debts, you reduce your interest charges, and you have a chance for success, to thrive, to keep your head above water as a company. So that very thrilling rendition is bankruptcy within our corporate realm. So I will upload your practice problems for your homework later this week, but this is a good start for you guys. Thanks.